Welcome to Business Studies for SS1 at Light Tech Academy. Today we study risk management in business. What is risk in business? Risk in business refers to the possibility of loss, damage, or failure that can affect a business and its ability to achieve its objectives. Every business faces risk, from fire and theft to economic downturns, competition, and natural disasters. Effective risk management is essential for business survival and growth. Types of business risks. 1. Insurable risks, pure risks where there are only two outcomes, loss or a no loss, not profit. These can be covered by insurance. Examples: fire, theft, flooding, accident, death of key employee, liability to third parties, e.g. customer injured on premises. These are also called pure risks because there is no chance of gain, only potential loss. 2. Non-insurable risks, speculative risks where outcomes can be loss or profit. These cannot be insured, they are the inherent uncertainties of running a business. Examples: change in consumer taste, competition from rivals, economic recession, government policy changes, technological change, wrong business decisions. Also called speculative risks because the entrepreneur speculates, accepts the risk hoping to make a profit. The entrepreneur and risk. Knight, economist, distinguishes, risk equals measurable uncertainty, can calculate probability and insure. Uncertainty equals unmeasurable, cannot be insured or fully quantified. The entrepreneur earns profit as a reward for bearing uncertainty, non-insurable risks. Methods of managing risk. 1. Insurance. Transfer the risk to an insurance company by paying a premium. If the insured event occurs, the insurer compensates, indemnifies, the business. This is the most common and effective method for insurable risks. 2. Risk avoidance. Identifying activities that carry high risks and avoiding them entirely. Example: a food company avoids processing raw fish, high spoilage risk, and sticks to dry goods. 3. Risk reduction, taking measures to reduce the likelihood or impact of a risk. Examples: installing fire alarm systems and sprinklers, reduce fire risk, security cameras and locks, reduce theft, training staff in safety procedures, quality control processes, reduce production errors, diversifying products or markets. 4. Risk retention, self-insurance. The business accepts and bears the risk itself, sets aside reserves, a contingency fund, to cover potential losses. Used when the risk is low impact and or the cost of insurance is too high. Example: a large company sets aside 5 million Nigerian nairas annually as a self-insurance fund for minor vehicle accidents. 5. Risk transfer, without insurance transferring risk to another party through contracts. Examples: requiring suppliers to ensure their deliveries, subcontracting risky activities, including penalty clauses in contracts. 6. Risk sharing, joint ventures and partnerships. 2 or more businesses share the risk and the cost of a project. Common in oil exploration, major construction, and agribusiness in Nigeria. Example: 2 companies jointly fund an oil pipeline to share the financial risk. 7. Hedging, a financial strategy used to offset risk in one area with a position in another. Commonly used for foreign exchange risk, a Nigerian importer paying in USD can hedge by buying USD forward contracts to lock in the exchange rate now. Also used for commodity price risk, oil exporters. What is insurance? Insurance is a contract, called a policy, between an individual or business, the insured, and an insurance company, the insurer, whereby the insured pays a premium in exchange for the insurer's promise to compensate for specified losses. Insurance converts an uncertain large loss into a certain small, regular cost, the premium. Principles of insurance. 1. Utmost good faith, uberumi fidei. Both parties, insurer and insured, must disclose all material facts honestly and completely. The insured must tell the insurer everything relevant about the risk. Failure equals policy may be void. 2. Insurable interest, the insured must have a financial interest in the subject matter of the insurance. You can only insure something you have a financial stake in. Example, you can insure your own car or house, but not your neighbor's car or house, unless you have a financial interest. 3. Indemnity, the principle that insurance puts the insured back in the same financial position as before the loss, not in a better position. You cannot profit from insurance. Exception, life assurance, not indemnity, pays an agreed sum. 4. Subrogation, after paying a claim, the insurer steps into the shoes of the insured and can recover the money from the third party responsible for the loss. Example, if a driver crashes into your car and the insurer pays you, the insurer can then sue that driver. 5. Contribution, if the same risk is insured with more than one insurer, each insurer pays a proportional share of the loss. Prevents the insured from profiting. 6. Proximate cause, the insurance company only pays if the loss is caused by the nearest/main cause that is covered in the policy. Types of insurance in Nigeria. 1. Fire insurance, covers loss/damage from fire. 2. Motor insurance, covers vehicles. Third-party insurance is compulsory in Nigeria, NECO and NECO requirements. Comprehensive insurance covers own vehicle plus third-party. 3. Life assurance, pays a sum on death of insured or maturity of policy. 4. Health/medical insurance, covers medical expenses, NHIS, private health plans. 5. Burglary/theft insurance, covers losses from theft or break-in. 6. Marine insurance, covers goods and ships in transit by sea. 7. Aviation insurance, aircraft and cargo. 8. Liability insurance, public liability covers claims by third parties for injury or property damage caused by the business. 9. Fidelity guarantee, covers loss caused by dishonesty of employees. 10. Crop insurance, covers farmers against crop losses, drought, flooding, pests. Important in Nigeria's agricultural sector. Insurance regulation in Nigeria. Insurance companies in Nigeria are regulated by NECO, National Insurance Commission. Compulsory insurances in Nigeria include third-party motor insurance, public liability for certain businesses, employees group life insurance for companies with 5+ employees, buildings under construction insurance. Remember, risk equals possibility of loss plus damage plus failure affecting a business. Types: insurable/pure risks, only loss or no loss equals can be insured, fire plus theft plus flooding plus accident plus death of key employee plus liability. Non-insurable/speculative risks, loss or profit equals cannot be insured, consumer taste plus competition plus recession plus government policy plus technology change. Entrepreneur earns profit as reward for bearing uncertainty. Non-insurable risks. Methods of risk management. 1. Insurance, transfer risk to insurer equals pay. Premium equals insurer compensates equals most common for insurable risks. 2. Risk avoidance, avoid high-risk activities entirely. 3. Risk reduction, fire alarms plus security cameras plus staff training plus quality control plus diversification. 4. Risk retention/self-insurance, business bears risk itself equals set aside contingency fund equals used when risk low impact or insurance too expensive. 5. Risk transfer without insurance, through contracts equals subcontracting risky activity. 6. Risk sharing, joint ventures plus partnerships equals 2 or more businesses share risk and cost. 7. Hedging, financial strategy equals offset risk, Nigerian importers buy USD forward contracts to lock in exchange rate. Now insurance principles, utmost good faith, Ibaramifidia equals full disclosure of material facts equals failure voids policy. Insurable interest, must have financial interest in subject matter. Indemnity, puts insured back to same financial position equals cannot profit equals exception. Life assurance subrogation, insurer steps into insured's shoes plus recovers from third party after paying claim. Contribution, multiple insurers pay proportional share. Proximate cause, pays for nearest/main covered cause. Types of insurance in Nigeria: fire plus motor, third party compulsory in Nigeria, plus life assurance plus health/medical, NHIS, plus burglary/theft plus marine, C, plus aviation plus liability, public liability, plus fidelity guarantee plus crop insurance, regulated by NECO, National Insurance Commission. Thank you and keep excelling at LightTech Academy, powered by LightTech Solutions Limited.